Good morning, everyone. Today we're going to talk about, or I should say, we're going to continue our previous video of Investor's Guide to Investing. Once again, this is the first playlist, which will go over what I think are kind of my collective strategies that I've developed over my years of investing. Um, they've worked out pretty well for me, and so that's something that I think that I wanted to share. But once again, this is not financial advice. Always make sure to do your own due diligence. So previously we covered in the core assumptions, core principles, and cautions. So things to look out for when investing, things that may cause potentially, what should I say, uh, significant losses or maybe even increased risk of huge shifts within your portfolio. Not to say that you can't make profit from them, but the goal, kind of going back to everything, is kind of being able to consistently produce profits while minimizing losses. That's the goal. So it doesn't matter if you, let's say, are in a position to 10x your potential equity, if you put yourself in a position where you could potentially lose all of your equity as well. So you don't want to essentially do a coin flip or even worse to get more profit. That's really not a good deal, at least in my opinion. So let's continue this discussion by looking at excellent company indicators. One of them is increasing revenue. That means that your product that you're marketing as a company is doing well. Say, for example, like Salesforce, Google Cloud, that's been increasing revenue about 30%, I believe, year over year, if I'm not mistaken. Things like let's say Nvidia has been increasing revenue in terms of how many chips they're selling. So this is all good signs of a growing company. Next up is increasing margins. So what are the ways that a company can increase margins? It can do it by cutting expenses. These include operational expenses like, as you may have heard in the news, like laying off a lot of employees. That's technically one way they could do it. It's a pretty uh, I don't know how to say it. Pretty savage way of, I guess, cutting expenses, just because people's livelihoods depend on those positions. But that's how companies can choose to cut expenses. They can also, in a better way, increase efficiency. That's the whole talk about trying to integrate AI into workflows to be able to produce more output with the same amount of input, or potentially less input. Um, and so being able to increase efficiency, the the time that it takes to produce a product, if that's lessened or if there's less material to make your given product, that's going to increase your margins. Think about all of those. I don't know why, but it comes to mind the Chipotle CEO, who essentially is like cutting out how much ingredients you get, or like restaurants that cut out how much ingredients you get, and essentially there, in a sense, it's not efficiency, but they're kind of cutting expenses by getting rid of ingredients. But they see it. I mean, they may potentially see it as an increased efficiency. Or actually, with respect to Starbucks, increasing efficiency, I see they're always timing workers, which looks pretty terrible because I can see the clock running on how fast an order takes to complete, and so that's the increased efficiency, I guess. They can also, of course, raise prices. We're no strangers to that. If you increase prices on your products, say, for example, if there's mentioning that the, I don't know, oils is going through a bit of a scare, you could see oil companies raise their prices ahead of time and suddenly have an increased profit. They're not really going to lose money. Next up is cash flows. So cash flows are going to come from their revenue minus the expenses, and so the available cash that they have to perform, or the available cash that they have, they have multiple avenues that they can use it in. One is they can decide to invest further into their own company. So let's say they perform more R&D. So they start looking for new products that they can develop and then sell on the market. Amazon's a really good example of this. They spend a lot on R&D each year, and then that way they're able to develop new products, and then afterwards that becomes a winner that can generate more revenue, more profit. Generally, when companies stop investing in R&D, that tends to or they stop investing in R&D and innovation. That's when companies tend to stall, and then over time tend to drop. Another way that they can invest their cash flows is with share buybacks. So they can authorize to allow to repurchase shares if they believe that it's accretive to the company. So for example, let's say I'm going to mention stock price, but really, whenever you're talking about the value of a company, you should be talking about it in terms of market capitalization. That's really how much a company is worth. Stock price is a measure of the market cap in a sense, but it's also gets affected by how many shares outstanding there are. So I don't usually like to say stock price, but in this example, I will. So let's say the stock price at a fair value should be $100, like PayPal. Right. Like, actually, that's one company that I'm invested in currently. I think it's a great company. It's undervalued, but it's currently at about, I think its fair value should be around $100. And we could talk about that from a valuation perspective later. But I think it's undervalued because currently it's sitting at around $68. So quite significant undervaluation. What's that? $30. 30 out of 70, 3 out of 7. What's that? 14, 28, 42%. Like about 40% increase, potential upside, in my opinion. And so when a company and PayPal thinks they're also undervalued, what they'll do is they'll authorize share buybacks. And so by purchasing more shares, what they're doing is they're able to take those away from the market, but they're also decreasing the number of slices of the company out there, and so that makes your slice, if you're a shareholder, a little bit bigger. So essentially what it does, it's the opposite of a dilution. By doing a share buyback, it's making your shares greater than what they were previously, and it should artificially increase the price. This is always a great idea when you feel that, or when a company feels that their company is undervalued, such as in the example of like PayPal, or previously when Google was down to like $160, $150. Buybacks were also a great idea. But anytime there's an undervaluation, share buybacks is one way that you can use your cash flows. Another way that you could do it is paying a dividend. Paying a dividend is a great alternative when you have excessive cash flows and maybe you don't feel that your company is undervalued. Maybe you feel like it's fairly valued or overvalued. Then paying a dividend is a better idea than buying back shares. So in my opinion, and just from the math perspective, it works out better that if the company is undervalued, you would prefer share buybacks like with PayPal. And if it's overvalued, you would prefer paying dividends. Or at value or overvalued, you would prefer dividends. And then that way you could give value back to the shareholders. Next up, have a company with high return on investment capital or high ROIC. So the way I like to define it is, it's flexible depending on the person, but I like to say 50% or greater. So if the investments that the company is making is exceeding the market, which is around anywhere from 10 to 11%, depending on what you cite, then I see that as beating the market. I see that as a great investment. If it's less than 10 or 11%, then that's not as exciting for me. I would prefer rather that they would do either share buybacks or paying a dividend, so then that way that equity can be provided back to me, and then I could invest the extra money in other equities that could potentially beat the market. Once again, share buybacks. So if you do see share buybacks, usually that signals that the company is undervalued, or the company believes it to be undervalued. Sometimes this can be a little bit of a trick because there are instances where share buybacks will happen to kind of ease the sentiment of the shareholders. So say, for example, if you believe that the company is going to drop in value, then you might authorize a share buyback, not necessarily a significant one, but just some value, so that way it kind of helps sentiment in the case that if there is a future drop, it won't be as bad. So it's kind of like lessening the blow. But for the most part, share buybacks is something that's only done when there's an undervaluation. Next up is increasing the dividend. There's a lot of dividend kings, companies which have had their dividend for, I believe, I can't remember the definition. I don't know if it's like 30 years, but essentially it has maintained their dividend or increased their dividend for X amount of years. And there's different levels of this. Think of Coca-Cola, think of AT&T. Usually it's like utilities. Usually it's like blue cap, um, uh, blue chip stocks that are increasing their dividend. So that's one way that people prefer to invest in, and that's a whole nother style of investing, which I could talk about later. I'm not a huge fan of dividend investing, just because I like to use covered calls uh, and a little bit of poor man covered calls, and as such, I don't really reap the benefit of dividends. But we could discuss that later. Next up is any kind of acquisitions that increases the company's moat. So, say for example, we have Google, which recently had an acquisition of a cybersecurity company. It was pretty large, I think. I don't remember if it was somewhere around 20 to 30 billion dollars. It was one of the largest acquisitions ever made. Keep in mind, Google was also the one who has just always made great acquisitions. One of them being YouTube. So they're known for being very intelligent and or I should say very good with their acquisitions. And so this is in one instance where it kind of works great with their current moat of being a cloud service provider. So it works synergistically in the sense that the cloud security company they'd be able to use that technology to uh, harden their own cloud infrastructure, but they could also sell that to other existing cloud providers such as Linode, maybe AWS, Microsoft Azure, and so forth. Next up is corporate refinancing to a lower interest rate. This is always a good sign. So typically, if you're a stronger company, and let's say you have debt that's going to mature, what you can do is if you're in a strong position, like let's say you have a lot of cash on the balance sheet, you can refinance and still leverage that cash. Instead of paying fully off the debt, you could kind of work a better deal so that you could lower your interest rate, thereby reducing the amount of interest that you're paying, and then that increases your available cash flows. So instead of paying down debt, you're using it to actually do one of the three investments, buybacks, paying a dividend, and so forth. Next one is a really, really good sign, and generally this is helping. This is a huge net positive to companies. This is something that I tend to look for, is companies that have the first mover advantage with the product. This is really highlighted with Amazon. Amazon was the first one to provide cloud services. Afterwards, it was a combination of, I believe, Microsoft Azure and Google Cloud, and so they did trail on. But usually the company that kind of first does something, some kind of action, some kind of product line, they will have that goodwill. They will have that kind of that audience that will stay with them, and they see them as more reliable, more confident, and not only that, they're able to kind of advance that technology and learn and kind of build off their mistakes faster than the companies that are trailing them. So think of, for example, another good one is Apple with its iPhone. It's been able to work out the kinks, and it doesn't have the same kind of issues as like Samsung with kind of blowing up batteries and stuff. I know that that's been resolved, but you could see how by having the first mover advantage, you're not necessarily as much of a rush, and you can spend more time kind of investing to get it right than kind of having to rush to catch up and potentially make mistakes, like with Samsung. uh, so I just want to note that I attribute this a great value if it has a first mover advantage. So whenever I see that, I think that makes it an excellent company, depending on what we're discussing, but it's usually huge. Next up, large cap stocks is usually a great sign. So if you're working with stocks that are 500 billion or greater in market cap, then generally the beta is going to be much lower, probably closer to 1, which is a reflection of the market's volatility, and then that will make it a safer investment, in my opinion, and less susceptible to manipulation and high fluctuation. Next up is when there's any kind of earnings that are reported. An earnings triple beat is excellent. So whenever there's a triple beat, so if it beats on revenue, it beats on earnings per share, and it beats on guidance by increasing its guidance, that means that the company is just doing outstanding. once again, this can be a little bit of a double-edged sword because sometimes what companies will do is that they'll kind of sandbag their revenue, earnings, and their guidance, and so that way when they report the next quarter, they're able to kind of beat it and kind of gain momentum. A good example of this is SoFi. SoFi has just always, I think, I don't think they've ever not beat revenue, earnings, and guidance. If I'm not mistaken, I'd have to check back on that, but I know that they're consistently handing out like great earnings, and so after a point in time, there ends up they kind of expect that to happen, and it can have a little bit of the opposite effect. So, say for example, if you don't get a triple beat, then suddenly it's seen as something's going wrong, just because it's known that the company already sandbags in a sense. So, SoFi has been caught in a little bit of this issues at times, but it's recovered. It's doing really well right now. But this is just something that whenever you see, that means companies in strong health. But once again, you have to look out for sandbagging. Next up is the increasing TAM, or total addressable market. This can happen in different ways. So let's say, for example, if you expand into new markets, like you're into new geographies, let's say you're going into Latin America, India, Asia, that could be one case. By going into those new markets, you have a greater market size, but also what you could do is you could change your product such that your market size increases as well. Can't think of a good example of this. Maybe your product is, let's say for example your product is something related to, like, let's say databases, and let's say it was only allowed to work with, let's say, like databases in English. That limits the market size, but by incorporating translation into other languages, suddenly that increases the market size, so your TAM goes up. Another way is PayPal. Actually, this is a great example. PayPal was able to adopt cryptocurrency, and there's a lot of companies adopting cryptocurrency. And by doing so, they're able to increase their market to reach customers that they may not have been able to reach before. You have to be careful about when people talk about TAM, though, because sometimes companies can be really. Sometimes companies and retail can really fall into this idea that just because your total addressable market is X amount of people, like let's say billions of people, it doesn't mean you're going to capture billions of people when you're actually selling your product. A good example is, like, let's say for example, if I were to start a water company, I could say my water company is able to reach 7 billion people because all people on Earth need water. But more realistically, I'm limited by geographies. I'm limited by distribution. I'm limited. So that's an example where I can kind of oversell what my actual total addressable market is. So you have to be careful about that sometimes, because they can make it seem a lot more far-reaching than it is. Next up, history of successes. This is really important because whenever a company has a history of success in turmoil, say for example like Google, it's been outstanding. Facebook, any company that's been able to go through the pandemic, any company that's been able to go through the 2008 crisis and not go bankrupt, you could see how they're able to kind of address those issues, how they were able to overcome, how should I say, kind of markets that were pretty unstable or pretty distressed. Then that shows you that there's competent leadership, and that also shows you that the product is pretty well desired. And so that gives you a lot more, or at least for me, that would give me a lot more confidence in going to that product. So for example, PayPal's been around for a while. It could kind of, maybe there's a chance that it could go away, but the fact that it's been around here for so long gives me a lot more confidence than, say for example, if it's a new company. How do I know that it's going to stay around? How do I know that it's in there for the long haul? Another good example of this is Nike versus like Lululemon. Nike's been a long-standing brand for I don't know, decades, whereas Lululemon has been a brand that's been around only for a few years now. And while Lululemon is pretty popular, you could see how the fad has changed pretty quickly. Whereas Nike, since it can be considered like retro, there's more of a chance of it kind of staying, even though it's trend based or trend influenced. I could see Nike being have a lot more confidence in Nike compared to something like Lululemon, which could fade as a fashion. Next up is the executive team must have clear guidance and measures to improve. So whenever you have any kind of CEO or any kind of C-suite team, you want to know that they have a history of being able to kind of improve the previous companies that they were assigned to. A good example of this is, I believe, for PayPal, they also had, I think it was their chief technology officer, or maybe their marketing. I'd have to look into it. But they came from another company, and they were able to just do really well and kind of revitalize the company. And then they came over here to PayPal, and that's something that really kind of gives confidence that they're going to be able to do something with respect to marketing. Let's say, for example, and on PayPal. That I'm not too, as you can tell, for that I don't attribute as much improvement to that. But what I do like, and this can be seen with PayPal, is that their focus is clearly stated that they're trying to increase profitability. They don't care as much about revenue growth. They care more about profitability. So they're renegotiating their current contracts. They're being able to increase their margins on those contracts, and it's been working. So you could see their EPS has been growing. Part of that's due to the share buybacks, but a lot of it's also due to just increasing their margins. So whenever there's clear guidance, that's great, and there's a ready plan. If it seems like they're a little bit all over the place, then if management doesn't know what they're doing, then it's not a good sign of a company. Next up. If a company has multiple revenue streams, Google is a perfect example of this. So Google has YouTube, has Waymo, Google Platform Services. Is it Google Platform Services? Google Cloud Services? I want to say it's Google Platform Services, maybe. Let's see. I think it's GCP. Google. Yeah, it's Google Cloud. But anyways, so going back to the Google Cloud, they have Waymo, they have YouTube, they have a diversity of revenue streams. And the reason why this is important is because actually more so with YouTube than ever is they were actually worried about losing Google Chrome or potentially being broken up. And if they were going to be broken up, let's say if they were to lose one of those revenue streams, or let's say some other company went and disrupted, let's say YouTube, and there was another way to be able to consume content, that's okay. They have other revenue streams that they can kind of depend on. So having that diversification is really important. Whereas, let's say, for example, if you only have one revenue stream and it gets disrupted, what do you do as a company? I'm thinking over here about, let's say you have a company that sells pillows, and then suddenly this other company sells much better pillows. What do you do then? Your whole business model is about selling pillows. So how can you pivot, right? If you don't already have multiple products. This also kind of lends into the next topic, which is customer diversification. This is really important to have diversification either by region, by market. And so let's say, for example, for regions, this is really important when there's any kind of political or regulation issues that may be encountered. Case in point is tariffs. When there was a prevention of NVIDIA to sell its GPUs over to the Asian markets, that cut off a whole revenue stream by region. But that's okay because NVIDIA also has a lot of other customers that are available here in the US, here in Mexico, and in other countries. And so they're still able to make a significant profit, and they're not worried about losing a certain, well, I shouldn't say they're not worried, but it's not disastrous if they lose a geography, kind of like a country that they're not able to sell to. The same thing with respect to how many customers you have. NVIDIA is not a great example of this because they have three main customers, which constitute most of their revenue, and this is for the data centers. They sell chips to house the data centers and kind of have that computing power. And if one of those customers were to, like, let's say, be able to kind of go into buy its chips from another company like AMD or such, then they would see a huge revenue loss. And so by only having three customers that are primarily driving your revenue, they're in a much less stable position. That said, at the moment, no one else is really able to produce the GPUs at the same level. So it's okay. It's not something that's too much of a risk right now for NVIDIA. But you could see how the more diversified you are in terms of customers, the more power you have. Next is the debt to asset ratio of less than 0.15. This is going to be sector dependent, as we said. Let's say, for example, if you're talking about a utility company, usually they have a lot more debt. So that's not going to be a good measure. But generally speaking, if a company has, let's say, a debt to asset ratio of 0.15 or less, that means that, let's say they owe 15 mil, or like let's say 15 billion in debt currently for the year, and they have about 100 billion of liquid assets on hand, then they're able to pay off that debt pretty easily. There's no issue. So that's a good idea when you have a lot of cash on hand and you're essentially not worried about having to. You're not worried about the cash burn. You're not worried about your liabilities, and you're also not worried about having to issue more stock and potentially dilute your shareholders, or potentially take a loan out at, financing at a bad rate. So this means you have a good balance sheet. This is just another way of saying your balance sheet looks amazing. Next up, high amount of current assets on the balance sheet. Yep. So this is exactly what I mentioned previously, which is actually this is. Let's go back. So this is just, you can refer to this for long-term debt and versus your current assets. So versus current assets, I'm referring to the short-term debt. So those are your liquid assets that you essentially can immediately liquidate versus your debts that you would need to pay off within the next year. So this is something, once again, this is a little bit more pressing because you want to make sure you have enough cash on hand for your liabilities. You don't want to go bankrupt, or you don't want to have the need to dilute or take bad financing. This one is with respect to, you don't want to be as leveraged. You don't want to use as much debt. You want to have a nice clean balance sheet. So I do want to kind of clarify that a little bit. For the next one, having a high percentage of institutional owners compared to retail owners. This is really important because the higher amount of institutional ownership means that the company the market cap tends to be a lot more stable versus like retail owners, which tend to be a lot more emotional. They see a little bit of a drop, like let's say by 1 to 2%, and they maybe think about selling. They see 4% drop. Oh no, it's the end of the world. That can be the case. Versus institutional owners, they'll kind of evaluate their positions maybe on a quarterly basis, on a weekly basis, monthly basis, but it'll be a little bit more strategic than, for example, I saw that this just happened today, and now my hair's on fire. So that leads to, number one, a lot more stability in the market cap. But number two, what that does is that gives confidence that a lot of kind of reputable companies have a vested interest in the stock. So they see that it has a future, it has potential. That's not necessarily needed, but it's nice to know that, let's say, for example, a lot of companies are investing in, let's say, Apple or Google, and so that gives a lot more confidence that if you invest in it, oh, maybe there's some future value in it. Next up, government contracts. So investing in government contracts, usually, once again, I think I mentioned in the previous video, is that they tend to increase over time. They're very sticky, so once you get government contracts, it's unlikely that you'll lose them. They kind of can be a bit of a slush fund in the sense that there can be a lot of waste and not too much accounting as far as how well it gets audited that the money is going where it's supposed to. Maybe this is me speaking a little bit more in just my views, but generally speaking, there's a lot of money to be made, a lot of profit can be had, and because it's sticky and it tends to increase, it's a good way to kind of count on revenue, increasing revenue over time. So whenever I see companies that have government contracts to some degree, and they're increasing over time, I think that it's not necessarily an excellent company, but I think it's something that, like, I would never want to bet against because it has a lot of stability built into it. Next up, the ecosystem. If the company has an ecosystem, this is essentially like a moat. This is a form of a moat, not is a form of a moat. This is not a moat, but this is a form of a moat, and I'll explain what I mean by ecosystem. A good example is Apple. Say, for example, if you buy an iPhone, you probably also maybe have other Apple-related devices like an iPad. You also have your cloud storage there, so you're able to save your pictures. You have it linked to your watch. You have it linked or Apple Watch. All of these is you're part of an ecosystem. It makes it really sticky for the consumer, and it makes it harder to leave. And it might make it more pleasant to be a part of. Another good example that I thought about was Amazon. Amazon is really good in the sense that, let's say you have Amazon Prime, so you're able to get all your shipping from Amazon. Well, as part of that, you're also able to view Amazon streaming and view like movies and shows. That's another part of it. Next up, maybe you're also a software developer and you use their cloud services. Like, let's say you use S3 for storage. You use like, let's say Amazon TextTract for OCR capabilities. You use Amazon Transcribe to extract subtitles from things. So there's a lot of cloud services available. Let's say you want to host your own website, you could do that using cloud services. Okay. Next up, on a day-to-day, you can also go to Amazon Whole Foods. So if you go to Whole Foods, that's a subsidiary of Amazon. So they reward you if you're an Amazon Prime member and you're able to enter your information and get a discount. And so that's how they bring you into the ecosystem. And you think, why not? I already get Prime delivery. Why don't I shop here as well and get a little bit of a discount? And then you start to associate the company with like positive things because you think, oh, this is my grocery store. I like it, and here's other ways I can help it. And building that ecosystem really makes it sticky and kind of a greater likelihood of adopting more or kind of purchasing more products of theirs. This is especially true for like banking. Once you buy one product, you're more likely to buy other products of theirs. So think of like if you were to take a personal loan from a bank, or you have a checkings account, savings account, you're more likely to get your like home loan from there as well. So that ecosystem is something that's really powerful and something to consider. Next up is the adaptability to changing trends and technology. So whenever you see a company being able to adapt to changes within society, changes within technology, changes within finance, any kind of changes that would potentially disrupt it, then that's a good positive. So if you see companies that they're adopting cryptocurrency, not necessarily because they may make a huge amount of money in it, but just so that they're able to kind of keep their customers kind of tied to the product or tied to the company. So once again, the reason why this is necessary is because if, like, let's say there's certain customers that if they don't see cryptocurrency involved, they might go to another bank where they're able to, be able to transfer their, $100, $1,000 worth of cryptocurrency, just so they have that possibility. Another good example of this is like Macy's. Macy's used to be the largest, how should I say, like, I don't want to say convenience store, but store where they used to sell everything. They used to sell furniture, they used to sell clothes, they used to sell tools, everything. Macy's had everything. It was essentially Amazon before Amazon. So Macy's was really huge. The one thing that they didn't anticipate, and this goes back to investing into R&D or just putting your cash flows towards investments. Macy's kind of stopped doing that because they thought, I can speculate that this is what they thought. We're making lots of money. We're already the biggest. Why do we need to invest more money into thinking about how to make our products better, or kind of investing in technology? What we've done is worked. Why do we need to change? Well, suddenly the internet came along, and Macy's didn't really advertise too much on the internet. They could have, and they could have stayed at the top, but instead, other companies like Walmart came along, and they were advertising on the internet, and you could purchase things, kind of look at what's available on Walmart, and then that ended up taking part of its market share. And then Amazon really stepped in and then just decimated Macy's. So by being able to adapt to the changes and incorporate technology, however it's being used, then that's more likely to keep you competitive within the market. Next up, going hand in hand with that, is being a technology related company. Why do I say this? If you have some kind of technology, usually that leads to higher margins. Just because with physical products, you have to pay for the raw materials or the components, and then you have to pay for the assembly, the manufacturing, and so forth. Whereas with technology, it's completely different. You pay your workers to develop the IP, the actual intellectual property, right? So you build the app or you build the software once, and then afterwards, well, it's kind of simplifying it a bit because there's a lot that goes into DevOps and kind of managing the life cycle of a technological product or solution. But in a sense, you build it, you kind of have an initial upfront cost of building it once, like let's say a video game. And then afterwards, you keep distributing it over and over and over again, and you don't really have to have that upfront cost anymore. You already kind of made it, and now you're just kind of handing it out for pennies on the dollar. Or as far as your operational costs, it's pennies on the dollars to you, but you're making a significant margin. So a good example of this is I used to work for a biomedical company where they made a kind of a physical products. They made physical products, but they also made software that had like a subscription to it, and then they would sell it to hospitals. And for the physical products, that was just kind of to get the hospital's foot in the door, so that they were able to use the software. And there was very low margins on that, very, very low margins. So they made hardly any money, or could potentially lose money on it. Well, why would they do that? And it's because the software itself, on there, they were making huge margins. I think like 70-80% margins. So they just a ridiculous amount of money on a subscription basis. So continual renewals and increasing renewals, just because the more health practitioners that needed to use the software, the more they could charge in terms of licensing. So technology, once again, is generally, it's a high margin business compared to physical products. Think of like restaurants. Restaurants make razor thin margins, very little, just because it costs so much to buy the actual food, and also the operational expenses of getting the chefs to prepare it, getting the staff to be able to serve it, and so forth. So all of that has a lot of costs into it, and so you're making very little money compared to kind of technological products. The exception to this is NVIDIA. NVIDIA makes a hardware product. It makes a GPU, and that usually, once again, should have like margins of, I would say, like 10% or less. It's usually very little. However, NVIDIA has margins of about 70+%. The reason why is because they have a huge moat. They build a GPU that cannot be outcompeted by any other company. No other company comes close at the moment, and so they're able to sell it at a premium. Now, that's not always going to be the case. There might be another company that's able to kind of step up and develop a GPU that matches theirs or maybe exceeds theirs. But let's say if even pretty closely matches theirs, then suddenly they're not going to have a 7% premium margin on their GPUs. They might only have, like, let's say 30-35%, which is still huge for a physical product. But if that were to be the case, then you're going to see NVIDIA drop like a brick. And that's because they no longer have those just huge margins, which are just even ridiculous for when thinking about technological solutions. Like it's just kind of crazy. Going into the next point, the company story. You want to make sure that the company story, what the CEO has stated as guidance, is intact or has improved. So, for example, previously PayPal was saying that they were focused more on revenue and increasing the amount of customers, the amount of accounts opened, the amount of interactions, but not necessarily the profitability. Whereas afterwards, they pivoted more recently into increasing profitability. And so that for me, that's I see that as an improvement. Now that they already have the increased revenue, go ahead and start worrying about profit. Additionally, look at their revenue streams, look at their acquisitions. Does it seem like they're all in line with each other? So they're a financial company, a payment company that's able to get kind of a part of each transaction, how should I say? They're able to get a little bit of profit from each transaction. And does that kind of fall in line with their business? Yep. And that's because PayPal was able to acquire Venmo. And so that's a financial payments company where each transaction they're able to get it. So that's getting it from a little bit of the younger people in a sense. Adopting crypto, they're able to get crypto enthusiasts. And once again, a little bit of the younger people. And then, of course, just generally PayPal checkouts that once again is more financial transactions, expanding to global markets. That's another more financial transactions, so kind of increasing that market. And so because their story has been consistent and has been improving in my opinion, then that gives me a lot of confidence. If suddenly they said, you know what, we're not going to do worry about payments anymore, we're going to start doing I don't know, we're going to build our own meme coin, I would be really, I think they might have. So maybe I shouldn't say that. But let's say they went into a completely different space and started building cell phones. Let's just say as an example. I'd be really confused. I wouldn't understand why they would make that transition. And I wouldn't probably be in PayPal anymore. Last up. If a company has a track record of successfully pivoting product lines, this means that the company is really adaptable, has good management, and if they're able to do it once, they can maybe do it again. And so that's usually the worst case when they're forced to pivot. But a good example of this, if they are able to, it means they're just an excellent company. An example of this is SoFi. So previously you primarily worked with student loans. Primarily they were student loan servicer. And then the pandemic happened and the student loans were suspended. And so you can imagine SoFi wasn't able to get any revenue from that because all the payments were stopped. So what were they to do? They transitioned to personal loans and mortgages, mostly personal loans, but also mortgages. And they just made a killing. They were able to kind of stay in business. They were able to make that swift pivot, and they were able to get a bank charter. So just being able to kind of handle that situation expertly gives me a lot of confidence in management and the company overall. So this is just a really great, a really great example of this case. Last up is a low beta stock. So any stock that has low volatility, so beta 1, which is means that it reflects the same volatility as the market. That means for me that's a plus, just because if there's huge swings in the company stock price, which means it's also swinging the market cap. What that leads me to believe is that there's a lot of changing variables with the company. It's maybe not as consistent. It's maybe subject to a lot of different regulatory policies that's causing the change. It's subject to federal regulations that's causing it to change. Maybe it's has a terrible balance sheet. It doesn't have a lot of assets on hand, and that's why it fluctuates a lot. Let's say with the market, and that's simply because if it moves a little bit with the market, that's completely normal. But if it moves a lot, it potentially could be because they don't have a great balance sheet. They have a lot of debt, and so as the market goes down, and let's say interest rates go up, that could mean that they're kind of negotiating from a point of weakness when looking for financing or having to dilute shares. And so that's another reason why it could drop like a bucket, the stock price. So anytime there's low volatility, that generally means that the company is a lot more reliable. So that should wrap up my excellent company indicators. For the next video, I'm going to go over what are some indicators of an undervalued company. Because once again, the principles are that you want to buy an excellent company at an undervalued price. Those are the principles that are investing principles that I have, and we'll cover that in the next one. So thank you so much for watching, and I hope you have a great one.